Hi, we're going to be discussing merchandising operations and internal control today. We're going to be focusing on objective number 3 and objective number 4. In objective 3, we are going to learn about how to prepare an income statement and record merchandising transactions under a perpetual inventory system. In Objective 3, we're going to learn about preparing an income statement and recording merchandise transactions under the Perpetual inventory system. If you wish to follow along with your textbook, you can look at the transaction entries on pages 287 and 288. In the income statement for a business using a perpetual inventory system, the cost of goods sold is constantly being updated during the accounting period as purchases, sales, and other inventory-based transactions are taking place. In addition, the merchandise inventory account in the balance sheet is also constantly being updated. This is because, again, under the perpetual inventory system, everything is constantly and routinely being updated. Any costs associated with freight in is included in the cost of goods sold section under a perpetual inventory system. In this particular section in Objective 3, we will review the types of transactions associated with the purchase of merchandise under the perpetual inventory system. The first type of transaction we're going to look at are all from the buyer's perspective. So if a buyer is purchasing merchandise, and we're going to assume that the purchase of the merchandise is on credit, in this particular transaction, we see that the buyer has purchased inventory for $4,890, and it's on credit, so it's on account. So they record a debit to the merchandise inventory and asset account, and a credit to the accounts payable account, which is a liability account. Now they're going to record the cost of shipping. Transportation costs on purchases. They're going to record this as freight in, which is in the cost of goods sold section of the income statement. So it's treated like an expense, so it's going to be debited. And because they're not paying for that at this point in time, they're going to pay for it at a later date, they're going to record again an accounts payable and create a liability. In this situation now, let's say some of the merchandise that they've purchased is the wrong product, or the product is not satisfactory to the buyer. Then the buyer must return all or a portion of the merchandise to the seller and receive a refund. The returned merchandise has to be taken out of the inventory account, and the amount of the accounts payable must be reduced by an equal amount. So in this transaction, we see that we record a debit to the accounts payable for $480, and then we record a credit to the merchandise inventory for $480. In both of these instances, it's reducing the amounts of those accounts. The last piece of this equation here from a buyer's perspective is when the buyer pays the seller for what they owe. So in this case, we see payment on account, and we see for the balance of whatever merchandise inventory was not returned. So if we look at the first transaction in this on this slide, we see that initially the buyer purchased $4,890 worth of merchandise on account. They returned a portion of the amount, $480. So we say $4,890 less the $480, and the amount that still remains outstanding to be paid is $4,410. So our accounts payable outstanding must be reduced by that $4,410. So we debit the accounts payable when we pay for it, and we credit our cash for $4,410. to show that we've made a payment in full on the inventory that we purchased. That takes care of the buyer's perspective. Now let's look at a seller's perspective. For these transactions, you can look at or go along with the pages on 288 and 289 in your textbook. From a seller's perspective, at the time of the sale, two sets of transactions are actually recorded under the Perpetual inventory system. The sale is recorded as well as the cost of the merchandise being transferred from the merchandise inventory account to the cost of goods sold account. So if you think about it, in a perpetual inventory system, meaning the accounts are constantly being updated, we have to record two pieces of the equation because at the time of the sale, we're going to reflect that the actual sale took place. But in addition, we have to reflect that there's a cost associated with that sale, and we have to reflect that our inventory balance on our balance sheet is going down because we've sold that item that was previously in inventory. So we record the two transactions as follows. We're going to debit our accounts receivable, and we're going to credit our sales. Then we're also going to debit our cost of goods sold to reflect the transfer of the merchandise inventory out of the merchandise inventory account from the balance sheet into essentially an expense item on the income statement. This applies the principle, the matching principle we've previously talked about, the matching of expenses with revenues. So now you can also see our merchandise inventory account is credited to show the reduction of that merchandise that we've now sold. You may also notice that the amount of the merchandise inventory is a lower dollar amount than the actual sale. If you think about it, that makes perfect sense because we want to make sure that we sell whatever our merchandise is for a higher amount. So if you think about it, when we purchase our merchandise inventory, we showed that purchase at $720 when we were the buyer. So we purchased it for $720, and now we're turning around and we're selling it for $1,200. The difference between the amount of our sale and the actual cost of our merchandise is what we call our gross profit margin. Okay, that's our markup on the item that we sold. When we look at the payment on delivery costs, the delivery is said to be an expense associated with the sale of the product. This particular item is accumulated in an account called freight out expense or delivery expense. This particular item is considered to be a selling expense of the business, and it is not typically included in the cost of the goods sold. It is typically accounted for in our selling expenses or our operating expenses for the business. Next, if a piece of the merchandise that we sold above is returned by our customer, then in this particular case, again, we have to update two types of accounts. We have to update the sales returns and allowance account and reduce our accounts receivable, and we have to also reflect the change in the merchandise inventory and cost of goods sold because that item is no longer sold. It's being returned. It's being returned into our inventory, and we have to reflect the reduction in the sales account. How we reflect the reduction in the sales account is by doing a debit to the sales returns and allowances account. We don't do it directly in our sales account because we want to try to show any sales returns as a separate account and keep track of it. From a business management perspective, we want to really make sure that we understand why there are returns and what those returns are reflecting. So from a management perspective, we check the sales returns and allowances in a specific or separate account considered to be a contra account or a contra sales account. So the normal side balance of the sales returns and allowances account is going to be a debit balance. That sales returns and allowance account is matched up or paired to the sales account, which has a normal balance of a credit balance. The two are netted together to give us our net sales at the end of the fiscal period. So, in looking at the transaction entries, we're going to debit sales returns and allowances for the amount of the return, and we're going to credit our accounts receivable because our buyer no longer owes us that amount that's associated with that return. We're also going to do a debit back to our merchandise inventory to reflect that that item is going back into inventory. And we're going to reflect a reduction in our cost of goods sold because that item is no longer considered to be sold. Again, you'll notice here that the balance of the amount that's going back into the merchandise inventory and the balance of the amount relating to the sales return and allowance are two different dollar amounts. The reason, again, has to do with the markup associated with the sale, but we have to record or reflect our merchandise inventory and our cost of goods sold at the amount that we paid for those items. The last piece of this equation is that we have to receive the amount that the buyer owes to us for the actual net amount that they purchased of inventory or of goods. So we reflect that we received in cash of $900 and we reduce our accounts receivable by the $900. Again, if you think about it, you look at the first transaction, we have a sale on account for $1,200. That sale on account was reduced by the sales returns and allowance of $300, and our account receivable was reduced by a comparable amount. So the amount outstanding in our accounts receivable is the $1,200 less the $300. So the remaining outstanding to the account receivable balance and the amount that the buyer owes us is $900. $1,200 minus $300 equals $900. So we're now collecting on that $900. So that concludes our discussion for managing merchandise inventory under the Perpetual inventory system. So the question is, how are merchandising transactions recorded under the Perpetual inventory system? Now let's look at preparing an income statement and recording transactions under the periodic inventory system. In this section, we will focus on explaining the income statement presentation using a periodic inventory system. When using the periodic inventory system, the cost of goods sold must be computed, but it is not updated for purchases, sales, and other transactions during the actual accounting period. The cost of goods sold must be calculated, and you must calculate it first by determining the cost of goods available for sale, and then adjusting for the ending inventory balance that you have on the balance sheet. Under the periodic inventory system, inventory is not tracked in the accounting system on a continuous basis as it is under a perpetual inventory system. The beginning inventory balance is carried until the end of the fiscal period, and purchases are accumulated during the period in a purchases account. The ending inventory balance replaces the beginning inventory balance to reflect or help us come to the balance of our cost of goods sold. So, looking back, if we look at this transaction or this equation up here on our slide, In order to figure out our cost of goods sold, we're going to take our beginning inventory and add to it any net purchases that we accumulate during the